So there's been a lot of back and forth about what happened and what didn't happen. I must say, Mr. Barr and his thinks that this was a textbook example of bank mismanagement out of Silicon Valley Bank. I think everyone agrees with that. Everyone agrees with that. But are there things that actually the regulators or the supervisors could have done to make it better?
So it obviously was a textbook case of mismanagement. But I think that explanations are usually most penetrating when they don't assume that the people involved were either fools or crooks. And so the question is, how could some of these decisions have been made, both by the bank management, by the Fed itself in supervising the bank? And there, I think, you have to look at the behavior of the uninsured deposits in Silicon Valley Bank and in the other banks that have failed over the course of the last 2 months, Signature Bank, First Republic. And the uninsured deposits at these institutions moved away from the bank with speed and at a volume that we had never seen before. I mean, the largest amounts that had ever run from a bank in the previously largest bank failures in the country's history had been, I think, $18 billion over the course of almost a month. And in Silicon Valley Bank's case, $42 billion left the bank in a day. And the bank was getting ready to open the next day with the expectation that another $100 billion would have left the bank. You'd have $142 billion leaving the bank in the course of 24 hours, which means that the liquidity requirements facing banks are much different. It was a mistake, but it was not a crazy mistake for both the bank managements and for the Fed supervisors to look at a bank with the liabilities of Silicon Valley Bank, funded almost entirely by its core business depositors, and say, we have an interest rate risk problem that's building in this bank, but thank heavens that the bank is funded by its core depositors, because those people don't tend to run. They certainly don't run quickly, and yet they did. And so the task for really figuring out what ought to happen differently going forward, what can the Fed do going forward, what ought banks to do going forward, is to determine why did those deposits behave differently.
And as I understand it, you know this better than I do, but as I understand it, it's not like the supervisors didn't see there was something going on. There were some notices given to bank management saying you do have an issue here. It appears that remedial efforts weren't taken fast enough. They saw it coming because of the mismatch on the duration. Is that at all because of a change in the climate in supervision, where people thought maybe we don't need to pay quite as much attention to supervision? As I understand, when you came in, you did say your first goal was to change the supervisory climate.
Yes. So yes, what I think still needs to happen to supervision. In fact, Silicon Valley Bank is an example of the fact that I didn't have the effect that I would like to have had on the supervisory culture. Is that supervisors, it's not just at the Fed, it's across all the bank examiners, and it's not just in the United States, it's really around the world. There is a natural tendency for supervision to become a very comprehensive compliance, check-the-box type of operation. And my message to the supervisors, it's very similar to the message that my counterpart at the ECB, a man named Andrea Enria, has repeated very recently in a speech that he gave in Frankfurt, was that we really need to be focused on the most important risk. We need to prioritize the risks as opposed to give the banks a huge menu of tasks that they have to undertake without prioritizing among them. And then we really have to focus our attention and the bank's attention on the ones that are most important. And as I would often say, smite them hip and thigh on the things that are most important. And when you look at the Barr report, it's the case that that just didn't happen at Silicon Valley Bank. There were 32 so-called matters requiring attention, matters requiring immediate attention at the end of 2022. This was sometime after I'd left the Fed. There was clearly no inhibition on taking supervisory action against the bank. You had 32 MRAs and MRIAs, but they were across a whole range of things that didn't matter for the bank, and very few of them focused on what was truly critical, and there was no prioritization among them. So I do think that has to happen going forward, and it's a unfinished business at the Fed.
Let me turn, if I could, to the question of the structure of the Fed and how it handles monetary policy as well as bank supervision. Because sometimes it feels like there's two separate functions. On the one hand, you had for monetary policy, for good and sufficient reason, a rapid increase in rates. So we know why that was, because of inflation. At the same time, it felt like it was entirely separate from. If you're going to increase your rates that fast, that far, wouldn't it make sense that there really is going to be interest rate risk? And did we really communicate one side with the other that if we're going to do that, we better take a hard look at interest rate risk at places like, yes, Silicon Valley Bank?
Yes, well, I think interest rate risk and also about the need to provide liquidity to institutions. We know from history, when I first came to Washington, it was in the government response to the savings and loan crisis of the 1980s, where, again, you had an inflationary episode and a robust Fed response to that inflation. That created significant problems for institutions that had interest rate sensitive assets and very mobile liabilities, in that case, the savings and loans. So we have historical experience as to exactly what to expect when the Fed is responding vigorously to a large inflationary episode. And one of the things that could have happened here was for the Fed to provide liquidity, which is one of the reasons for the existence of the Fed, as opposed to requiring Silicon Valley Bank to sell its assets into the market and to crystallize the loss, which was the proximate trigger of the run on March the 9th and the closure on March 10th. But Silicon Valley Bank wasn't prepared to borrow from the Fed. It hadn't done sort of the necessary legal work to provide collateral. And that's because the Fed has lost the thread a little bit about its fundamental core purpose, which is to provide liquidity to banks and to the financial sector generally in episodes just like this, when there's reason to see that coming. They tell the banks, you have to have all of your own liquidity. You have to have enough liquid assets that you don't need any liquidity from the Fed. And there is no bank that can survive $142 billion going out the door in 24 hours. You have to rely on the central liquid reserve at the Fed. It's why it's called the Federal Reserve, to provide that liquidity. And the Fed should certainly now be, and should have been leading up to this episode, ensuring that all banks are prepared to be able to borrow from the Fed should they need to. Had Silicon Valley Bank been able to, we would not be in this position. They would have received liquidity from the Fed in order to continue to pay out their depositors.